Good morning and welcome to TOI Japan Market Radio. This is November 25, 2025. I'm your host coming to you from Tokyo, and this is your daily briefing for global investors tracking Japan's equity, currency, and bond markets. Let's dive straight into today's session with our portfolio manager. How are things looking across Japanese markets today?
Thanks for having me. We're seeing a mixed picture in Japan today. The Nikkei 225 closed at 48,659.52, up 0.069%, so essentially flat with a slight positive bias. Meanwhile, the TOPIX finished at 3,451, down 0.174%, showing some divergence between large caps and the broader market. The Mothers Index, which tracks growth in smaller companies, fell more notably by 1.165% to 2036, reflecting some risk-off sentiment in that segment. On the positive side, J-REITs gained 0.787% to 2049.0, suggesting yield-seeking flows are intact. Over in currency markets, the dollar-yen is trading at 156.111, down 0.368%, so we're seeing a modest yen appreciation today.
Interesting divergence there between the Nikkei and TOPIX. And I see commodities are also showing some movement. Gold priced in yen is up 2.753% to 15,490, while crude oil dropped 2.039% to 57.64. Let's turn to the main stories driving sentiment. First up, we're seeing global equity markets getting support from rising expectations of a Federal Reserve rate cut. Reuters is reporting that stocks rallied while the dollar remained relatively steady. Walk us through why this matters specifically for Japan.
This is quite significant for Japanese markets on multiple fronts. What we're seeing is the market pricing in higher odds that the Fed may ease monetary policy in the near term. For Japan, this has several direct implications. First, if the Fed cuts rates, we'll see U.S. Treasury yields decline, which narrows the yield differential between U.S. Treasuries and Japanese government bonds. That spread has been one of the key drivers supporting dollar strength and yen weakness over the past couple of years. A narrower spread reduces the attractiveness of the carry trade, where investors borrow in yen at low rates and invest in higher-yielding dollar assets. Second, easier Fed policy typically boosts global risk appetite, which is positive for Japanese equities, especially exporters and cyclical sectors.
So we're looking at a potential turning point for the yen then? How should investors be thinking about the currency impact here?
It's nuanced. The prospect of Fed easing does create a mild appreciation bias for the yen, because the dollar loses some of its interest rate support. However, we saw today that the dollar remained stable overall, which suggests this remains more of a medium-term theme rather than an immediate shock. The yen moved down 0.368% today, so we did see some modest appreciation, but nothing dramatic. For Japanese equities, this is actually a mixed signal. In the near term, the risk on sentiment from Fed easing expectations is clearly positive for the Nikkei and TOPIX, supporting cyclicals and export-oriented names. But if the yen strengthens significantly from here, that becomes a headwind for earnings at major exporters like the automakers and electronics companies. On the rate side, Fed cuts could pull JGB yields lower through cross-border flows, which would keep the Bank of Japan's yield curve control framework well anchored.
That's a helpful framework. Now, shifting to regional geopolitics, we're seeing reports that tensions between China and Japan are clouding both market sentiment and the tourism outlook for Japan. This is coming from Finamize today. What's your read on this development?
This is an important and somewhat underappreciated risk for Japanese markets right now. The escalation in China-Japan geopolitical tensions creates headwinds across several key sectors. Tourism has been a major growth engine for Japan post-pandemic, and Chinese tourists represent a very significant portion of inbound visitors and consumer spending. We're talking about meaningful revenue for retail, hospitality, luxury goods, and related services. If those flows diminish due to political friction, it directly hits corporate earnings in those sectors. Beyond tourism, there's also the broader trade relationship. Japan and China remain deeply interconnected economically despite political tensions. Supply chains, especially in automotive and electronics, could face disruption. Companies with heavy China exposure, whether through sales or production, are at risk of margin compression if these tensions persist or escalate.
So how does this translate into market impact across equities, currency, and bonds?
For equities, this is clearly a negative, particularly for cyclical sectors. Tourism-related stocks, consumer discretionary names, and industrials with China exposure are most vulnerable. We could see some rotation into defensive sectors, which might outperform on a relative basis. On the currency side, it's a bit mixed. Typically, risk-off sentiment and geopolitical uncertainty support the yen as a safe haven currency. So we might see some yen strength if tensions escalate further. However, if the economic impact is severe enough to weigh on Japan's growth outlook, that could limit the yen's upside. For JGB yields, I'd expect them to remain anchored or even decline. Flight to safety demand would support Japanese government bonds, and yields would likely stay low, which actually helps the Bank of Japan maintain its current policy framework without much pressure. So this is definitely a story worth monitoring closely, especially for investors with exposure to Japan's consumer and industrial sectors.
Absolutely. Meanwhile, in Europe, we're getting some positive news on the automotive front. The European Automobile Manufacturers Association reported that car sales in Europe rose 4.9% in October. Given the significant presence of Japanese automakers in Europe, what does this mean for Japan?
This is moderately positive news for Japanese markets, particularly for the automotive sector. Major Japanese automakers like Toyota, Honda, Nissan, and Mazda generate substantial revenue from European sales, so a 4.9% year-over-year increase in October is a constructive signal for their earnings visibility. What's important here is understanding what's driving that growth. Is it stronger overall European consumer demand, or is it market share dynamics where Japanese manufacturers are gaining ground against European and Chinese competitors? Either way, it's supportive for Japanese auto stocks and their suppliers. From a macro perspective, strength in European car sales suggests resilience in European consumer demand more broadly, which is also positive for Japanese capital goods and electronics exports to the region.
And what about the implications for the yen and Japanese bond yields from this news?
The direct impact on currency and yields is relatively minimal. This is more of a regional sectoral indicator rather than a macro-shifting data point. That said, if this European strength reflects a broader global demand recovery, it could contribute to a mild risk-on environment, which might support some yen weakness, and that would actually be favorable for Japanese exporters. For JGB yields, I don't see a meaningful immediate impact. This isn't the kind of news that shifts expectations around Bank of Japan policy or drives significant flows into or out of Japanese government bonds. The real beneficiaries here are the equity investors holding Japanese auto and supplier stocks, names like Toyota, Honda, Denso, and others in that supply chain. It's worth noting that the positive momentum in European sales needs to be sustained for this to have a material impact on full-year earnings, but it's definitely a step in the right direction.
Staying with the global demand theme, how do you reconcile the positive European auto sales with the concerns we discussed earlier about China-Japan tensions affecting tourism and trade?
That's a great question, and it really highlights the mixed picture facing Japanese markets right now. On one hand, we have supportive factors like potential Fed easing and resilient European demand, which are positive for risk assets and Japanese exporters. On the other hand, we have regional geopolitical risks and sector-specific challenges, particularly around China exposure. For portfolio construction, this suggests a barbell approach might make sense, maintaining exposure to Japanese equities to capture the upside from global demand recovery and easier financial conditions, while being selective and perhaps underweighting sectors with heavy China exposure or tourism dependency. The currency dynamic is also key to watch. If the yen strengthens materially from Fed easing, that becomes a headwind for exporters, but if geopolitical risk keeps the yen supported as a safe haven, that's a different dynamic altogether. Right now, we're at 156.111 on dollar yen, and the direction from here will depend heavily on the balance between these cross currents.
Let's bring this together for our audience. For global investors tracking Japan today, what are the key takeaways from this session?
I'd highlight three main themes. First, rising Fed rate cut expectations are creating a supportive near-term backdrop for Japanese equities, particularly cyclicals and exporters. But watch the yen closely because significant appreciation could erode those benefits. Second, China-Japan tensions are an underappreciated risk that could weigh on specific sectors like tourism, consumer discretionary, and companies with heavy China revenue exposure, so sector selection matters more than ever. Third, positive European auto sales data reinforces that global demand for Japanese products remains resilient in key markets, which supports the earnings outlook for major exporters. The overall message is that Japan offers opportunities, but investors need to be selective and aware of the cross-currents between global monetary policy, regional geopolitics, and sector-specific dynamics.